In the year 2000, corporate leaders believed combining a tech giant with legacy media would forge an unstoppable monopoly. As this chart demonstrates, that single handshake cost investors over $165 billion in plummeting shareholder value. It resulted in a $99 billion corporate write-off in a single year, the largest in human history. The fallout reached far beyond Wall Street. The collapse dismantled long-standing careers and bankrupted retail investors who had trusted the corporate projections. Modern markets show that corporate size does not guarantee safety, and vision without execution is merely a hallucination. To understand how a miscalculation of this magnitude occurs, we must look back to 1999. The early internet was a highly volatile, untamed frontier. Ruling over this chaotic landscape was America Online. You can see the scale of their physical distribution in these installation disks. At their peak, over half of all internet traffic in the United States flowed through their servers. Driven by that enormous market share, their stocks soared to incredible heights, entirely detached from traditional financial metrics and logical valuation. While their balance sheets appeared invincible on paper, the entire operation rested on a foundation of speculative momentum rather than sustainable hard revenue. AOL CEO Steve Case recognized this vulnerability. He understood the tech market was dangerously overextended and likely to correct. Billions of dollars were inflating the valuations of internet companies that generated virtually zero actual profit. When the market correction occurred, that artificially inflated equity was positioned to instantly collapse toward zero. To survive, Case needed a mechanism to stabilize his equity. He sought to trade his digital stock for hard physical assets before the market sentiment shifted. This required a legacy corporate partner, one whose leadership was increasingly preoccupied with their own perceived lack of digital relevance. Back then, Time Warner stood as the undisputed heavyweight of 20th century media. Unlike the digital startups, they possessed immense tangible value. They owned buried copper networks, massive film libraries, and physical infrastructure like this global CNN newsroom. Yet CEO Gerald Levin faced a severe corporate vulnerability. His stock price was completely stagnant. The market ignored Time Warner's steady, reliable profits, pouring capital instead into the explosive growth rates of tech startups. Faced with a market that punished stability, Levin increasingly prioritized a digital pivot over the traditional financial caution that built Time Warner. This desire for a digital future provided Case with a unique opportunity to trade his overvalued stock for permanent assets. On January 10, 2000, the two companies went public with their plan, a massive $165 billion all-stock merger. The financial press celebrated a theoretical synergy, praising the combination of new internet distribution with legendary media content. Behind closed doors, aggressive tech cultures and traditional media veterans clashed, creating a friction that would eventually shatter the entire enterprise. Corporate divisions refused to communicate. This cultural mismatch devolved into institutional paralysis, completely freezing the combined company's ability to innovate. The resulting failure was not an accident, but a continuous erosion of value, caused by deep-seated gridlock and strategic misalignment. The final descent of this $100 billion empire was ultimately triggered by the arrival of a single, unexpected internal email. The record-breaking valuation of the AOL Time Warner merger collapsed under the weight of operational friction before the integration plan was even finalized. Behind the celebrated high fives of the leadership team, a workforce misalignment was already eroding the deal's potential. Human friction derailed the merger in ways that capital alone could not fix. Ignoring the human element of an acquisition guarantees that even a billion-dollar investment will result in operational paralysis. Corporate culture acts as the invisible engine of revenue, determining how effectively a workforce can execute a business strategy. AOL operated with the aggressive speed of a tech startup, relying on a chaotic, reactionary internal structure to drive growth. Time Warner functioned as a traditional media conglomerate, governed by a slow-moving and rigid corporate bureaucracy. Time Warner executives viewed the younger AOL staff as arrogant children who had built an empire on overvalued stock. The AOL team saw the Time Warner side as a collection of dinosaurs, unable to navigate a shifting digital landscape. Combining world-class assets produces no value when the two workforces responsible for managing them are in a state of active mutual distrust. The financial promise of the deal rested on synergy, the idea that cross-promoting products would lead to exponential scaling for both brands. Under the plan, AOL was tasked with selling Time magazine subscriptions, while Time Warner would distribute AOL installation discs with every physical movie release. Both divisions failed to execute. Department heads prioritized their own territory, effectively blocking cross-promotional initiatives before they could reach consumers. This internal resistance transformed the merger into a war of attrition, with different branches of the same company actively obstructing each other's success. The trillion-dollar promise of synergy disappears the moment human operators prioritize internal rivalries over collective growth. External factors soon intensified the internal crisis. In March 2000, just months after the merger, the dot-com bubble burst. This chart shows the Nasdaq climbing through 1999, then dropping sharply in 2000, erasing trillions in market value. AOL's ad revenue was tied to tech budgets. When they collapsed, AOL's revenue flatlined in lockstep with the market. A company mired in internal conflict loses the agility required to pivot when a macroeconomic shift destroys its business model. As the leadership teams remained deadlocked on internal policy, they missed a shift in consumer behavior, the rapid move from dial-up to high-speed broadband. This AOL disc illustrates their reliance on time-metered access. The company's entire subscriber base was built on the 500 hours free model. That model was limited by the hardware of the 56K modem, which relied on restricted standard phone lines. New hardware, like this DSL router, enabled always-on connections that made the dial-up subscription model unnecessary. While the executives were preoccupied with internal bickering over corporate hierarchy, the technical transition to broadband left their infrastructure behind. The Time Warner board realized that the future of the internet they had purchased was already a legacy product, losing billions of dollars as the market moved on without them. By 2002, the fairy tale was over. The largest merger in corporate history had stalled, and the optimism of the previous decade was gone. Leadership had to inform shareholders of a devastating reality. The AOL side of the business had lost its entire value. They reported a $99 billion write-off. Let that number sink in. To this day, it remains the largest single corporate loss ever recorded. This collapse broke the traditional scale of financial failure. It forced Wall Street to establish a new, far more dangerous baseline for corporate disaster. The market reaction was a hemorrhage. The stock price, once trading at $70 a share, plummeted to less than $10. The fallout moved quickly from the exchange to the real world. Thousands of regular employees lost their jobs, and countless personal pensions were wiped out. The architects of the deal were the next to fall. CEO Gerald Levin was forced to resign as the company's value evaporated. Steve Case, the visionary behind AOL, was purged from the empire shortly after. Time Warner spent years trying to scrub the association from their brand. They eventually dropped AOL from their name and spun the company off for a fraction of its original price. The collapse proved that even the most powerful executives are vulnerable when a hype-driven strategy inevitably fails. To understand how this $165 billion machine imploded, we have to look at the three specific flaws that made the failure inevitable. Threat Vector 1, the hype cycle. During a market frenzy, momentum often replaces logic. This merger took place at the peak of the dot-com bubble, an environment where traditional financial health was ignored in favor of rapid expansion. Massive deals were being made based on the potential of the internet, rather than current, verifiable revenue. This environment created a distortion field, where massive financial risks were rebranded as visionary leadership. Threat vector number 2, the internal friction of a failed integration. Even the most detailed financial strategy is useless if the people tasked with running the business cannot work together. The merger brought together two groups that actively despised each other: the old guard corporate culture of Time Warner and the aggressive tech-centric world of AOL were in constant conflict. This internal warfare burns through capital and focus faster than any external competitor ever could. When a company is divided at its core, it eventually consumes its own value from the inside. The final flaw is a lack of adaptation. AOL's success was built on a dial-up internet model. Their leadership believed this model was an invincible monopoly that would last forever. This overconfidence made them blind to the technological shift happening right in front of them. As they continued mailing out trial discs, the world was moving toward high-speed broadband. By the time they tried to pivot, their core service was already a relic. Arrogance creates a blind spot that can turn a market leader into an obsolete memory overnight. While 2002 is a historical event, the conditions that triggered the collapse are becoming visible again in modern institutional finance. In sectors like AI and crypto, we see the same reliance on future potential over current earnings that defined the year 2000. Protecting your capital requires looking past the growth charts and investigating the cultural health and technological flexibility of the companies you invest in. In the world of finance, unchecked arrogance remains one of the most expensive liabilities on a balance sheet. Today, some of the largest tech conglomerates are beginning to mirror the structural issues that broke AOL, including internal sprawl and aging core products. Looking at the market today, which company do you think is showing these symptoms of stagnation? Let me know in the comments. To understand the larger pressures building in the US economy right now, click the video on your screen. Stay sharp, and I'll see you in the next one.